Just a quick reminder that trading conditions are going to thin out from here through next Monday as the U.S. market starts to head off the desks for the end of summer long weekend holiday. But we will get some positioning and volatility ahead of and around tomorrow's monthly employment report out of the U.S. As things stand, any stress associated with the recovery has been put at ease yet again by the Federal Reserve, with most of the movement in markets over the past week a direct result of the Fed making investor-friendly adjustments to its policy guidelines. And yet, interestingly enough, enthusiasm around this adjustment has been fading in the currency market in recent sessions, with the U.S. dollar coming back into favor. The same can't really be said for U.S. equities, which continue to extend their run of record highs, as seen through the NASDAQ and S&P 500. Chatter and hopes for an earlier release of a coronavirus vaccine have also been helping to prop investor sentiment, though we're skeptical about any market rallies on less than reliable news about the timing of a vaccine, news that also ignores the reality of a longer economic recovery irrespective of a quicker-to-market vaccine. There's plenty of tension on the global trade front and plenty of uneasiness around the upcoming U.S. election. Throw in exhausted monetary policy and fiscal stimulus efforts, and we're not as convinced everything as peachy as the stock market would want you to believe, or should we say the Fed would want you to believe through their unprecedented efforts to keep the stock market propped up. We'll be keeping an eye on the U.S. dollar to see if there's additional demand, because if there is, it may warn of a rush to safety, which would then compromise the ridiculous run in stocks. But again, we are heading into a thinner trading conditions, and none of this may offer any clarity until market conditions get back to normal after the long holiday weekend. That's all for now.